Welcome to the Morrison Report podcast. I'm so excited that you decided to join us today. Today, we're going to discuss mortgages, variable, fixed, interest rates. And today we have joining us, Jiang from Outline Financial. Thank you so much for joining us this morning, Jim.
Thank you, Devia, for having me.
Awesome.
Pleasure.
Awesome. So why don't we first start off discussing the new interest rate increase that just came out this week. So the Bank of Canada has increased its rate to 0.5%. Now, there were rumors that it was going to be 0.75%. Any insight or thoughts around the rate increase this week?
There were expectations for 0.75%, as well as 0.5. It really depends on the bank's stance. So from this recent rate hike, just looking between the lines, it seems like the bank is giving us information about their point of view in terms of economy. They're starting to giving us a little bit of a stance of, we understand that the economy is getting into a little bit of a recession, pre-recession outlook. We are aware of that. And therefore, I think this 0.5% is more or less the middle ground, where they don't go too aggressive with another 0.75 or 1% even, but they rather lower a little bit to give us a little breather and potentially, maintain or slow down that increase and paving the way for that future rate trend. So that's what I'm getting from that. We don't know, obviously, what the future outlook is. It really depends on inflation numbers and overall economy. But we know the bank is very strong on lowering inflation. However, from the recent rate hike, we are starting to see them giving more weight to the news of, the wording of a recession, economic, impact. So that's what we can get out of this.
Got it. Interesting. So I believe also the head of the bank, Tiff Macklem, mentioned that there might be a bit of a pause coming. So for example, there is another rate hike coming on December the 7th. What do we think may or may not happen for the next interest rate increase, or I guess rate hike or announcement, I should say, not increase. I should not make assumptions.
Well, it certainly looks like that way with every time it seems like there's a continuous increase, right? From my point of view, he's giving that kind of idea to us, and the main reason is because with these rate hikes, they have been increased very fast. So that's why they were kind of calling it front loading, where they're trying to kind of bring down inflation very fast and very aggressively. But as you know, economy evolves slower than that. Impacts come in slower than that. So therefore, there has to be some point where they have to have some type of a pause, right? If the number is starting trending in the right direction, which inflation is trending in the right direction, it's coming down, but there has to be a period where they have to monitor. What's the impact? What's the result? Should we continue? So I think that's in the back of their mind. However, if inflation is, staying the same for the next inflation data, or maybe even increase, that's a different, then they have to take a different stance. But if it comes down, I think they're going to slowly have that monitor effect.
So would you say that this aggressive way of increasing rates is normal? Does the Bank of Canada normally increase rates at this aggressive rate?
I personally don't think so. And also looking at kind of the historical norm, right? Like the expectation has always been, 0.25 or maybe 0.5. Even with the data right before the rate hike in the beginning of the year, when they, before they did the aggressive rate hike, people are pricing in based on 0.25 each time. So having a 1%, 0.75, even 0.5, even with a 1% increase, that's about four times the normal expectation that we were expecting. So I personally feel this is not the normal stance. This is really to be very aggressive on bringing down inflation because the overall consensus is that the central bank globally, or at least US and Canada, was slow on trying to curb inflation. Therefore, they need to step it up.
Interesting. So then let's talk about a little bit about variable versus fixed rates. So right now, based on the bank rate of being 3.75, where is sort of the approximate average that you would see a variable rate? And where is the approximate average where you would see a fixed rate right now?
So that's very interesting. Traditionally, variable rate, and looking back 25 years on average, a variable rate is lower than fixed rate. And this is way more evident in the last maybe 5 to 10 years, where the spread, basically the spread is how much the variable rate is versus how much the fixed rate is. That gap is much bigger in the last 5 to 10 years. But recently with the rate hike and with the speed of rate hike, variable rate has increased dramatically, right? So if you're looking at right now, comparing a 5-year fixed and a 5-year variable, and this rate I'm using is for properties that are just traditional mortgages above $1 million property in value, right? Those regular kind of detached, semi-detached range. Mm-hmm. We're looking at low 5 to mid 5s for 5-year fixed. And we're looking at similar, low 5 or even high 5s for variable rate. So that gap between the variable rate and fixed rate is almost non-existent. And in certain cases, variable rate is even higher than the fixed rate because of the recent aggressive rate increase.
Well, that's not normal, is it? That you have the variable and the fixed so close together?
That's not normal in my opinion, and that's not normal historically speaking as well. The main reason most people take variable rate is because normally speaking, they have a much lower rate than fixed. There has always been a spread between variable and fixed, maybe about 1% or maybe 1.25% or 1.5%. So that's why people are willing to go on variable rate, take on the risk to face the uncertainty because they're winning, they're getting a deal. Right. So this kind of spread now that variable is higher than fixed, it almost kind of eliminates that benefit.
So, I mean, it's very interesting. So, for example, someone now, are they going to do the variable mortgage or are they going to do the fixed rate mortgage? And then my other question is, if they do that fixed rate mortgage, that means they're going to be locked in at this high rate for many years to come. Whereas if they tough it out with that variable rate mortgage, they won't necessarily be locked in at the high rate because presumably rates will come down at some point, or maybe that's my impression. What are your thoughts about that?
Yeah. So I always like to, clients always ask me those questions, and I'm sure you see a lot of articles online because right now people are asking these questions given how high the rate is. When I talk with clients, I always tell them I look at things in 2 buckets. I always look at the term, kind of interest rate or mortgage term option by looking at risk versus return. So the first thing I talk with my client is I look at the risk bucket as the basic foundational step. What I mean by that is, looking at clients' cash flow situations. What's your income? Is your job a stable job? Do you have a variable income? How much mortgage you have to pay versus how much you make? Do you have a good net worth? Do you have RSPs, TFSAs? Parents can support you if things goes wrong, or if you have cash. And lastly, I will also look at, do you have insurance in place potentially? What if something happens? So if clients are very stable in those areas, then you can still choose between fixed or variable. But if clients sometimes are telling me, I really don't have much net worth left, my income is not stable, I don't have the adequate help, I probably just to, pick a fixed rate, whatever term that makes you comfortable, and stick with that, because that will not impact you dramatically when the rate changes, right?
Right.
So, and then once you are able to, go past that risk bucket, and then I will probably look at the return bucket, which then the client can look at, okay, well, and this is the most fun bucket because this is more speculative. And this is why I tell my client, I honestly do not know. And I can only tell you my opinion and my opinion alone. So that's the first point is historically variable rate is lower than fixed. Therefore, you pick a variable because you are benefiting from it. Right now, variable is on par or potentially higher than fixed rate. So that benefit, in my opinion, is gone. So why would I take that risk potentially right now to do that? Second thing, penalty. If you pick a fixed rate, which is to your point, if you pick as a fixed rate and when you happen to sell your property, you may be upgrading, or maybe you want to change your amortization or doing anything with your mortgage that is material, you are incurring a much larger penalty. We're talking about tens of thousands comparing to a variable rate where it's just 3 months of interest. And then lastly, the expectation of or speculative expectation of interest rate in the short term. My current expectation for the short term is based on what the Bank of Canada is saying is that in the short term, they're very aggressive on interest rate and they're looking to increase, sustain, or as you said, or pause. But the result is the rate will still stay elevated in the short term. In the long term, we're talking about mid to long term, 3 to 5 years. The expectation is they are potentially going to slowly decrease or drop dramatically because the higher rate is not really benefiting our economy, given our current situation at this time period. So therefore, for my clients, based on those, I'm probably looking at either a 1 to 3 year fix, right? So therefore, you have a short duration play, or you pick a 5 year or 3 year variable if you can sustain the risk, because you're gambling on the fact that maybe after 2 years the rate drop dramatically, so I'm going to win compared to somebody, who pick a longer term.
Interesting. So then, for example, what would be an approximate 1 year fixed rate if someone said, okay, you know what, I'm just going to fix right now because that way I can get a rate that's lower than the variable rate, but they don't want to take the risk of holding on to that fixed rate for too long because in their minds, the rates are going to come down and they don't want to have to break that mortgage once they get it and incur some of those penalties. So what would be, let's say, a 1 year fixed at this point?
Very interestingly, in the fixed world, the 5 year right now is actually, we can find a lower rate than the 1 year fix. The reason is because when you look at fixed rate, the most popular fixed rate term is 5 years. So therefore, because of that volume and interest, and there's more kind of in-depth reasoning behind it, but I just will not go through it today. But therefore, a lot of times you see potentially deals on the 5 year versus the shorter term. So right now, for example, 1 year fix, still not bad, around 5.3 range. Okay. Comparing to maybe a 5.1 on the low side for 5 year fix. So you're paying a little bit higher, but you're taking less risk in the sense that you're taking 1 year.
And also with the 5 year fixed, I mean, sure, the rate is lower, but if you have to break it, that penalty can be quite substantial in terms of how much you have to pay. So it might be worth the risk of doing the 1 year fixed, or maybe it's just worth the risk of crossing your fingers, hoping for the best and doing that variable rate. I don't know.
That's correct. That's at least my opinion is 1 to maybe 3 years, depends on your kind of outlook, your personal situation. Obviously, every client is different. But in the general sense, if you pick a 5 year fix, you have to be very certain that you're really not going to change the mortgage, any material change, which we all know on average, kind of people make changes to their mortgage on a 3 year basis, but most people pick their 5 year terms.
It's funny. I was actually going to ask you that question because I've certainly heard that before from mortgage brokers, that on average, people do break their mortgages after 3 years. So someone who enters into that 5 year fixed rate is most likely going to pay a penalty because they are breaking that mortgage. So yeah, I mean, if that's the average, and what is the reason why people are breaking their mortgages after 3 years? Is it, moving, upgrading, change of life circumstance, divorce? What would you say the major reasons would be?
You're absolutely right. I mean, Some of the reasons are that you mentioned are basically unavoidable in the sense that, let's say, if you're going through a divorce, you have to settle, then obviously you have to make changes to the mortgage terms and, or those incidences that you cannot avoid. So we also see a lot of cases where clients are, for example, as you mentioned, upgrading, right? Want to get a bigger property, so they're wanting to sell it. And sometimes they're able to port that mortgage over to a new property, but sometimes they needed more mortgage and they might need to break the current mortgage to make changes. And really depends on this personal circumstances and the type of product they got. But yeah, there's a lot of things that could happen. Also, in my opinion, real estate is one of those assets where you have the benefit of leveraging without having to, getting kind of margin called or making changes to your mortgage as long as you make payments. Mm-hmm. So people are they sometimes take advantage of that, keeping real estate and grow their rental investment portfolio by re-leveraging their property, borrowing to refinance, and grow their wealth exponentially. So that way.
Right. Interesting. So then talk to me a little bit about, I thought it was interesting that when you said you were looking at a client's profile as to whether they should do variable or fixed, you looked into, of course, everything about their own wealth and situation. But I thought it was interesting that one of your factors that you also look at is, can their parents help them? And
that's correct.
That's a common thing right now. So that's even one on the things on your list that you look into that.
That's correct. Because as we all know, the baby boomer kind of wealth transformation, transferring to the next generation, we're witnessing that right now, right? That's why you're also seeing a lot of that wealth, through investments or transfer to their kids. So that's just a natural progression, right? And also that doesn't include their parents, but also include maybe other family members. Mm-hmm. Just any resources that you could potentially ask for help is something that can save you during a very kind of volatile time, right? When things changes, when the rate goes too high.
Absolutely. So then let's switch gears a little bit and chat about HELOCs. So first of all, why don't you explain what a HELOC is in case someone in the audience doesn't know, and then we can talk about what's going on with those right now.
So HELOCs are homeowner line of credits. So we typically just call them HELOCs. How I look at it is this, if you look at a mortgage, you have a pretty much, it's basically a loan. What it means is that as you pay it down, the amount that you paid reduces the mortgage, reduces that loan, and eventually you finish paying that loan and you are basically debt free. If you want to reborrow again, you probably have to do another application with the bank, reassess your situation at that time and your property to take out the money again. A homeowner line of credit is basically a kind of a product that came out when people are realizing, hey, sometimes I might not need the money right away. I don't want to go through continuous applications if I want to keep on borrowing. So they thought of an idea similar like a credit card, where you use and pay as you go, and you would only incur interest rate per usage. And the difference between them and the credit card, obviously, is the rate is much, much lower, first thing. And second thing is the homeowner line of credit, they'll act similar to a credit card. They don't have the 21-day grace period. So even if you use it for a day or even use it for a week, they will calculate that daily rate in terms of how much you owe in interest. The line of credit is a homeowner line of credit is attached to your real estate. That's why it's kind of called a homeowner line of credit. And because of that securitization, the banks wanting to lower interest much lower. Therefore, for you to use is a much better way to use than a credit card or other form of line of credit.
So then can you, I guess, is there an average that you would say the rate is right now for HELOCs?
So you're probably looking at somewhere between prime, which is the Bank of Canada's prime rate, right? So currently we're probably looking at 5.95 is the prime rate right now after the rate hike. And usually there is a plus in there. It really depends on the client's credit, net worth, and overall situation. The bank really prices based on that. You could have situation where it's prime, which is 5.95. plus a percent, plus a 0.5%, or even plus 1.25%. Certain situations with great client profile and maybe strong previous relationship with the bank, they might offer prime rates. Those are situations we can see as well to reduce the pricing for those type of clients.
Interesting. Are you seeing people who are sort of coming to you now with issues that they need refinancing, whether it's because of the HELOC or because the interest rates have gotten too high, so their mortgage payments have gotten too high? Are you seeing those kinds of issues come up right now?
I'm seeing more. I'm seeing more people at least is kind of starting to understand and engage us more. I've always advocated all my clients know that I always advocate to have a kind of annual review of their a quick annual review of their finances with me, so that I can determine their borrowing power into the future and, basically lay out a plan, right? So right now, clients, yes, are coming to me if they have some issue with the cash flow. We might look at potentially refinancing their property to get some extra money out to alleviate that pressure for the short term. Also, for other clients who are new home buyers, they're also coming to me to do some scenario analysis as to what if this happens, what if this happens. Then they have a better understanding so that when they're looking at properties, they feel comfortable at kind of what pricing range they can afford, and so it helps them to make a better kind of decision, a judgment call.
That's great. I love that you meet with your clients on an annual basis to, analyze what their situation is and their borrowing power is like. Do you work with a lot of real estate investors, like in terms of what's the profile of the real estate investors like versus someone who has just got their principal residence?
I do work with a lot of real estate investors. I also work with on the commercial side as well, which is from my previous experience. That's something that I also focus on. With real estate investors, they understand, I think, in the sense that they have been experienced a lot more in terms of getting exposure to this area. They understand the rate situation. Most of the cases, like myself, I'm also a real estate investor. And most of the cases, I always advocate of having an emergency fund in place. So most of these very mature investors, they are already prepared for these. They know what they're getting into. If they do pick a variable rate, they already have cash on hand to prepare themselves there. So all of these interest hike really doesn't really faze them. Rather, what they're looking at right now is how they're looking at more of a opportunity than a kind of glass half full view.
Right.
So including myself, I know people are always complaining before, I don't want to get into a bidding war again. I don't want to go crazy on that. It's just too frustrating. Well, for those type of clients, the opportunity is starting to, become more balanced or potentially in your favor, because, investors or first home buyers are looking at the market and they maybe can have the opportunity to bargain more. And they are looking at it. That's from the mortgage perspective. A lot of investors are coming to me, starting to say, hey, can you refinance some of my properties? I'm wanting to get into the market. Or some other investors starting to ask me to review their profile and see what they can do if they were to buy a property. So definitely seeing a lot of those activities.
Interesting. Now, because the rates are going up so aggressively, there's certainly been a lot of talk out there, and there's been a lot of doom and gloom out there about, oh my God, all these people are going to have their properties have to be sold by, power of attorney and foreclosed and nasty things like that. Are you seeing that right now, that there are people who can't pay their mortgages so that they have to sell them?
I don't see a lot of those. See a lot of those. I think people are prepared. I think the stress test definitely helps. Just for people to know, when the stress test was introduced, for most of the deals were stressed at 5.25%. So most people are relatively comfortable at that range. Now I know it's a little bit higher, but it's not a major difference than how much we're stressing them. So I don't see that. I don't know the future outlook. Obviously, really depends on the economy as well as how high the rate goes. But for the short term, my point of view on real estate long term is still very bullish, given how attractive Toronto is for immigration. and overall, just anyone in terms of in a North America or global scale, how Toronto is compared to other cities. It's a place where people want to live. So therefore, people who, just as I said, invest in the short term, they are very bullish in the long term. And that's why they are starting to looking at deals. If they didn't have that bullish outlook, they wouldn't even start looking at deals right now because, if they expect things to go down in the long term terribly, why would they invest now?
Mm-hmm. That makes sense. So, one of the things you just mentioned was the stress test. And yes, that's correct. A few years ago, they brought that in to stress people out. So now that, mortgage rates are much higher, is there still a need for that stress test of stressing people out at, a rate that's 2% higher than the going rate? Or is it time for that stress test to go away?
Well, it's really, if you look at it, the stress test really is from the kind of regulatory and kind of government's point of view. Their point of view will always be sometimes even being over negative, because if you're being over negative, they can lower the rate or have a different point of view in the future. But if, let's say, they drop the stress test at a rate and something happens, it might impact them negatively. So a lot of cases, they rather be a bit more aggressive until maybe the government or the bank tell them to say, hey, we need a bit more stimulus. This doesn't make much sense. We need to change. But until then, I think they are, at least is going to be lean towards being overly negative side. Then maybe especially when the general sense right now is for the government is trying to bring down price. And that's kind of their objective right now in terms of in the price of everything. So that's why they're increasing rates, right? So at the short term, I don't see they are making changes to that. But if things changes and they're starting to realize this is kind of unnecessary, then they will probably maybe lessen it to start off. Maybe drop a stress test rate sometime.
That's fascinating. That's great. Anything else to add, Jim, before we close off?
Nothing to add except for just wanted to voice that especially for business for self clients at this moment, especially maybe at the year end, they're looking to file their personal taxes. Some of them are looking to file talking to their accountant about their final year end financial statements. I highly recommend, if they have a rental portfolio or expect to purchase real estate, talk with a professional. You can reach out to me, obviously, to review your finances and come up with a calculation so that your borrowing power. I'm not getting into a mistake of filing and ended up being that the number you filed is really cannot get you much of real estate out there.
Great. That's very, very helpful, Jim. Thank you so much for joining me today. This has been really fascinating. Lots of information. I'm sure our listeners got lots of information out of that. And I'll touch base with you in the future. But thank you so much for joining us today, Jim.
Thank you, Lavelle. It was a pleasure. Thank you so much.
Awesome. Thanks for listening to the Morrison Report. Bye for now.